Hey, welcome back everyone. It is time for another red hot cover call video. Well, hey, look, today we're going to talk about buying a deep in the money call option. This would be something that a lot of people on the internet are talking about, how you can make more money and you can spend less money. You would have the ability to make money while the stock moves higher. So we're going to use NVIDIA for an example here. I'm going to try to break this down as simple as possible. You know, there's a lot of videos out there where these YouTubers are talking about buying deep in the money call options in lieu of buying the shares. Now, this in itself is not necessarily anything that would be speculative, but you do need to understand what you're buying. See, when you buy the shares of NVIDIA, for which today's example is going to be, you own the shares and you are entitled to any of the dividends that company might distribute while you hold the shares. Buying a deep in the money call option has many moving parts. Many of the folks on YouTube that talk about this, they get you to the 20-yard line. They don't truly get you there. This video is going to get you there as to why it's so important. You need to understand every element of a deep in the money call option. They make it sound so simple. Oh, we're going to spend less money and we're going to make more money and you can buy many, many more for the amount of money you would have spent buying NVIDIA stock. Now, I'm not going to rip anybody here. Everybody has their own skill, their own talent, but I'm going to share with you my experience. See, I do poor man cover calls all the time. Now, what that means is, if you've never heard of the poor man's cover call, it means that we are going to buy a deep in the money call option. And we're going to write near-term covered calls as if we own the shares. So the poor man's covered call, buying a deep in the money call option. Now, you can buy that deep in the money call option and do nothing with it. And that's what a lot of these YouTubers do suggest, like this guy right here. His name's Lee, the smart option trader. He suggests that you just buy them. Instead of buying the shares, he uses Apple in that example, you would buy a deep in the money call option. Now, as Apple moves higher, you would reap that benefit because you're buying a call option that has a delta attached to it. Now, that delta is going to be a percentage. The option that you're going to buy moves based on a $1 move in the stock. I'm going to show you all this in this video. Now, am I being critical of anyone on YouTube talking about this? Of course not. They're trying to educate you. They're trying to give you ideas. But when it comes to buying call options, deep in the money call options, there's risk. You need to know it, and I'm going to show it to you right here. So you can have all the tools in your toolkit when you make these decisions. Buying options, they can be risky. So we are going to talk about that risk and why it's risky. Because these videos that you'll hear out there, they make it sound like it's not risky. I'll tell you what, at the end of the contract, something they don't really tell you about, there is a consequence. We have to take action. We're going to talk about that here in this video. So let's go ahead and get to this. If you've never been to my channel, I want you to subscribe to the channel. We're going to talk about how we can generate income using the very same call option that everybody's talking about. So I want you to stick around. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what I'm doing is this. We're talking about this deep in the money call option that's all the rage. You know, when stocks are down, that's a great opportunity to take a long bullish position, right? The stock market always comes back. That's what they always say. I agree with it. But when we buy the stock, we can set it and forget it. When we buy a deep in the money call option, we can't do that. Well, we could do that, but at the very end of the contract, you better have your money sitting to the side to buy said shares. This strategy of buying deep in the money call options sounds great on paper, and if you understand how to do it, it can be very profitable, for which you don't spend that much money. But this video is all about showing you and helping you understand what the call option is that we're purchasing, just so you can make a good decision with the best information you have. Now, let me start off by saying we're going to use NVIDIA, and NVIDIA at this moment, while I was putting these slides together, it's trading for $105.38. Okay, that's important because that's going to affect our deep in the money call option pricing. Okay, Number one, before we continue, I said in the lead up here that when you own the shares, you're entitled to a dividend. When you buy a deep in the money call option on a company, you're not entitled to the dividend. And some people don't quite understand that. See, what you're buying is the right, but not the obligation to buy this person's shares at a certain price that you pick. So he's technically owning the shares, so he collects the dividend. So with that said, let's talk about that deep in the money call option and how it's priced. On screen, we're going to use this example. So many of the YouTubers out there will talk about buying a deep in the money strike, largely because as we get deeper and deeper in the money, the delta is attached to every single call option that you would buy or sell. The delta on a deep in the money strike gets bigger. It gets closer to the number one, one being 1 for 1. The stock moves $1, this call option moves $1. Typically, you can't find those. You'll find a 99 delta leap. By the way, a deep in the money call option is called a leaps call option if you're going to give yourself 6 months to a year, for which most people suggest on the internet. So we're going to call it a leaps call option, largely because when I do my videos, I'm always talking about the poor man's covered call, where we buy that deep in the money call option and then we write near-term covered calls as if I owned the shares. The leaps call option gives you the right but not the obligation to buy somebody's shares. So you're going to pick that expiration date of this leaps call option. Now, most will suggest picking a year. Now, looking at the screen, you could see we picked March 20th, 2026. This means if I pick the 65 strike, and what that means is I'm going to buy this guy's shares at 65. I'm going to pay $45.70 to buy that right. Now, we're going to talk about that price here in a minute. That 65 strike has a 90 delta leap, and this is going to be for 330 days. So you're going to have the right to buy this guy's shares at 65 for 330 days. To buy that right, you're going to have to pay $45.70. If you were to add up 65 and 45.70, that actually equals more than what NVIDIA is trading for right now. NVIDIA in this example is trading for $105.38. You buy the right, but not the obligation to buy somebody's shares at 65. You're going to pay $45.70. That means your cost is $110.70 per share. So it's very important to understand you're paying somebody out there a premium to have the right, but not the obligation to take his shares. Think of it this way. That guy's a covered call writer. He owns NVIDIA shares, and he's basically writing a covered call. He's picking the March 20th, 2026 strike expiration date. He's going to give you his shares at 65, and you're going to pay him $45.70 for that right. So that's what's happening on the other side of the trade. Now, on this side of the trade, we're buying that right off of that guy. So we're going to pay about a 5.05% premium to this person. Now, that means that's $5.32 you are shoveling out to this guy to have the right. That's it. You're not obligated to those shares at all. That's a good thing and a bad thing. But I want you to understand the pricing, because that's very important. And that's going to play a big role here as we get close to expiration, or when you have to make a decision. Now let's talk about that delta. It's very important. The delta is one of the most important things. Most people never talk about it, and that just frustrates me. Because an options delta is a relationship between a $1 move in a stock and the leaps call option, or the deep in the money call option, moving with it. So in this example, if NVIDIA were to move $1, this leaps call option, because it's a 90 delta leap, it'll move 90 cents. Now you can see there's a 10-cent difference there, and that doesn't seem like a thing, but you're losing 10 cents for every single move. Now, I guess that's what you got to give up to be able to invest less money. Because remember, you only invested $45.70 per share. Or on 100 shares, that's $4,570. Whereas, had you bought 100 shares, you would be paying $10,538. So you see how you're only paying up a portion of the upfront money? Well, you're paying that upfront money for the next 330 days. At the very end, you're going to have to make a decision. We're going to talk about that. What happens if NVIDIA moves up or down? Let's talk about that. If NVIDIA moves up, and in my example here, say NVIDIA moves to $120 per share. That's a $14.62 move in the stock. Your option, because it only moves 90% of that, is going to be $13.20. Now, I hope you're getting that the delta represents how much your Leaps call option moves based on a $1 move. If you haven't gotten that yet, you need to rewind and listen. The options delta dictates how much it moves if NVIDIA moves $1. Now, I'll also tell you this. If NVIDIA were to fall $14.62, your option would fall $13.20. So you make 90% on the upside, but you only fell 90% on the downside as compared to a full move with NVIDIA stock. So looking at those numbers, look at the gain. You're thinking to yourself, man, how can you make 30% when the option moves $13.20? It's because you only ponied up $45.70 for the right, but not the obligation, to buy his shares. On a $45.70 option that you bought, it's now worth $58.90. That means your cash on cash percentage gain at that moment is 28.89%. Absolutely clobbering what the actual stock did. The stock moved from 105.38 to 120. That's a 13.87% cash on cash gain. So you can see the allure to spend less money, and you can potentially make more cash on cash invested than if you own the shares. But in recap, because I'm going to show you how we can make money while we hold this deep in the money call option, because those YouTubers will talk about how you just hold it and you hold it for 330 days, whether you're up, down, whether you make money or you don't. Let's recap and then talk about what happens at the end. The recap is simple. If I were to buy 100 shares of NVIDIA, that's $105.38 times 100. It's going to be over 10,000 bucks. If I do the deep in the money call option and we pick that 90 delta or the 65 strike, we're only going to pay about $4,500. Now the trade is on. We're in this game because if NVIDIA goes up or down, we are going to benefit or get kicked in the nads because this thing moves 90% of a $1 move. So the trade is on. And we understand we paid this guy $5. You do know that the stock has to move $5, $6, and $7 higher for you to even break even. Well, here's what happens now. We're getting close to expiration, and I'm going to throw a couple hypotheticals at you. We're getting close to expiration, and let's say NVIDIA is trading at 105. How incredible. Let's say right now at 105, 1 year from now, it's gone up and down and up and down, and next year, March 20th, 2026, it's trading at 105. Well, your option's worth $5 less than what you paid. You have to understand the pricing of a call option. You have intrinsic value and time value, which makes up the entire price of an option. So do you see the option price for which you paid $45.70? Part of that is intrinsic value. Go ahead and subtract $65 from $45.70. You're going to come up with a number. That number is going to be $105.38. The other part of it, that's what you paid the call buyer. He's getting paid, man. He got $5. He got 5%. That's gone come expiration because time value decays as we get closer to expiration. It's called time decay. It's called theta. And here is the deal. If NVIDIA trades in and around 105 come expiration, the final month we start to get time decay. And that portion, that $5.32, starts to erode with every single day we get close to March 20th, 2026. And yes, on the final day, that final Friday, on the 20th, your Leaps call option that everybody said buy, is now trading for $40. $40. You've lost $5. So you got to understand that. You have to understand it. If you don't, you're going to be broken. Now, do understand that if the stock goes higher, you could reap all the benefits. And if the stock goes lower, you're getting crushed just like the shareholders themselves. On expiration, what happens? If you let the market maker close the trade and the stock finishes above 65, you're going to own those shares. So you better have the money. If you don't have the money, you are going to be placed in a short sale of NVIDIA stock. You have to have the $65 that you bought, the right, but not the obligation to take that person's shares. It's going to happen. If NVIDIA falls all the way down to $65.01, you are buying NVIDIA stock at $65. You have to close the trade. Why do you have to close the trade? Because if the market maker assigns you to shares and we wake up Monday morning in March next year and NVIDIA falls another $20, you are literally holding the bag of death. Like, you have to get out of this trade. You have to be in control of this trade. Now, you can close the trade by just selling the Leaps call option. Or you could actually call your broker and say, I'll take control of the shares, paying $65 per share. But do understand, come March 20th, 2026, you're going to own these shares at 65 if it trades above 65. Now, it would be beautiful if NVIDIA moves above 105 and you can make a little bit of money. And what we're really hoping is that NVIDIA goes to 150, and of course you reap a 90% gain of a $1 move. That would be $45 on the stock side. You'd get 90% of that. You'd be pocketing a serious profit there. Now let's talk about if we're going to do this. Would you like to make some income using that deep in the money call option? Well, you've heard of covered call writing, because if you're listening to this video and you're thinking about buying deep in the money call options, then chances are your brokerage is allowing you to buy call options, which means you have a higher level of options trading ability at your account. So you understand, I'm sure, what writing covered calls are all about. But did you know if you own this Leaps call option, you own the paper to buy this guy's shares at 65? If your service level is set up with your account, you can write calls against that. And we call that the poor man's covered call. Now, you know exactly why it's called the poor man's covered call. We don't pay all the money to buy the shares. We only spend $4,570 to buy the right, but not the obligation to take his shares at 65. Well, with that paper in hand, we can write a covered call. I'm going to give you an example right here of my poor man's covered call tracker that you can get in the description below. Now, all my members have the poor man's covered call tracker. If you're going to do a covered call, you have to use this tracker, because I'm going to show you in a couple screens here how we set up a trade. And I'll be brief, but look, this is the tracker. You need to use it. When we set up this trade, we used the expected stock move calculator, which you see right there, and where might my Leaps call option be priced calculator. And of course, we keep track of all the data in the tracker itself. Real quick, let's take a look at this trade. It's very important to use the initial trade setup. That's inside the tracker. You get this inside the tracker. So the setup is simple. We're going to use NVIDIA. We're going to buy for $105.38. We're going to pick that March 20th, 2026. We know that's about 330 days. We're going to buy the right, but not the obligation to take this guy's shares at 65. We're going to pay $45.70. That's a 90 delta leap. It moves. This Leaps call option moves 90% of a $1 move. Now it's going to cost us $4,570. We're paying the call buyer 5%, but we're paying him $5.32. That's a lot, right? Well, this is what we now need to do. We made that purchase. We now need to write a covered call. We want to generate income while we're holding this. Now, I kept this one a little bit tighter. This is a poor man's covered call trade. If I was truly holding this Leaps call option for stock appreciation, I would pick a strike price for which they'd take my shares away from me, much more out of the money. But for this purpose, we're going to use a tighter number. We're using the 111 strike. And the 111 strike for a 30-day trade is going to render $3.40 in covered call premium. And that's going to be at $8.48 money in the pocket if this trade ends at 111 at expiration. That's going to represent the entire trade, 18.58%. And if we just keep the premium alone, well, 7.1%. So you want to make sure you set up your initial trade setup so you understand the profitability of your Leaps call option purchase. Now, the tracker itself is simple. You plug in all the yellow and you keep track of all your near-term covered calls. And you can see how I set the first one up in the upper part of the tracker. Now, the bottom part of the tracker talks about the expected stock move. So we go to an options chain, we bring up an at the money IV or at the money implied volatility, and it's going to return a number. We plug that into the calculator. It's right there. I show you how to use it. There's even a video. Do you see the videos on the far right? Well, you plug that in and I see that it could move to 119 on the upside. Now the premium wasn't much for that, so I selected the 111 strike. Notice where might my Leaps call option be priced calculator at the bottom. When we plug in those numbers, it returns that I'm going to make about $50.77. Look at the upper right. You see this total trade for 30 days would render 7.5%. We make money on the covered call and we make money on the deep in the money call option we purchased. But if you wanted to learn more, I do this at my membership all the time. You can become a member. In the description below, I have a 1-month free offer for you. Hey, look, if you want this calculator, I'll tell you, even if you're just going to buy a deep in the money call option, this calculator is great. You could use the middle part to determine how much time value cost you're paying for that option. Because at the end of the day, the cost is not $45.70. The cost of the trade is the $5.32. Now, if you didn't quite get that, then I need you to become a member because I teach all of my members all of this, and we're writing near-term covered calls using deep in the money covered calls. Hey, look, I'm going to leave it there. In the description below, your 1 free month offer. Would love to welcome you aboard. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.